Hey, everybody. This is David Dowd from David James Investments. And today we're joined by a very special guest. This is my partner in the commercial real estate space.
Hey there, name's Hani Moomin.
I hope everyone's getting comfortable. Get your cup of coffee, your tea, strap in, and also get a notepad out so that you can take notes as we go through talking about everything commercial real estate today. So we'll get it kicked off here with the conversation.
I got into this as a change of career early in the pandemic. Come from the world of healthcare and chemistry. Just kind of fell into this business by chance. Started the way a lot of loan officers do in residential real estate, which I still do, but I would consider my bread and butter to be commercial real estate today. It's quite different from doing loans on the residential side, but it's a lot more flexibility, a lot more options. You're not just helping people buy houses. And I would say the clients are a little bit easier to work with too, because it's not like a family that's coming out and making the biggest purchase of their life. You have someone that's typically accustomed to making these larger purchases. They're not overwhelmed by the numbers and the process. Once you get your groove going, I find that it's a little bit easier and there's more return business to be had. People don't usually buy two, three houses a year. Whereas if you find a good fix and flipper, you find a good broker that's willing to send you deals, sky's the limit.
Absolutely. How long have you been doing commercial real estate, honey?
So I got into commercial real estate about 2 years after I got into the residential side of things. Let's call it about 3.5 years I've been in the industry.
What would you say is your goal in commercial real estate?
The goal, as with any loan officer, is to close as many deals as possible. I work as an account executive on the private money side. My goal, in addition to closing as many deals as possible, is to help as many of my brokers get comfortable in the industry and close as many deals as possible. The more deals they close, the better that is for me.
When you think about the long-term effects of some of these commercial deals, we're also talking about maybe a building is made, maybe a neighborhood is made. Perhaps something that changes people's lives can happen through these transactions, even though we're only a part of it in that very beginning of what ends up becoming something much more spectacular. I think that that's really nice.
Most loan officers are never going to do a 5, 10, 15, $30 million deal if they just stick to the residential side. If you come into the commercial space, the loan amounts are much larger. That's always part of the incentive of trying to transition into this space as well.
What do you love most about commercial real estate?
I'll answer it in the context of what do I love about the industry compared to the residential side. I love having the conversation with my brokers, people that don't know that there are additional routes to making money beyond just doing a loan on a house. They bring me a loan that finally closes. That's always a good feeling. On the fix and flip renovation side, I've had multiple people where they came to me for their first fix and flip, nervous, not knowing how to do it, and they turn around and churn a six-figure profit, money that they've personally never seen before. And now they're coming to me for 3 projects a year, being very enthusiastic about it. So that makes me happy. I've seen people change careers. I've seen people go from being cosmetologists. I work with police officers, people that now exclusively work in real estate because they see they can do 3 of these projects a year and build generational wealth.
That's very powerful to see that growth, to see that change in people.
What I love most are people who come back, people who came to me for their first loan and now they come to me 2, 3 times a year.
Repeat folks, the regulars, if you will. What are the challenges of doing commercial real estate?
That's an easy one to answer. So on the residential side, you
Yeah.
have someone that sends you a loan, they send you their finances. One of the first steps in the process is to get a purchase contract. You verify their assets. That person wants that house. If everything goes right, that transaction is going to close. They're going to bring the money. That's a guaranteed commission for you. That's a guaranteed sale for the realtor, etc., etc. Closing rate on the commercial side is much lower. If you can have a 50, 60, 70% closing rate, you are doing excellent in this industry. Because a lot of people shop around. You're talking large loan amounts, and you'll have a lot of people that'll come to you to originate a loan. They'll poke around, and once you get to, let's say, the background check or the credit check process, they kind of just fall off the face of the earth. There's a lot of window shoppers, much more so than on the residential side. And since we only get paid on things that close, I wouldn't call it wasted time, but you are putting a lot of time into projects that will never get you paid.
Okay.
However, if 1 out of 8 of those projects closes, you're talking a 12.5% closing rate, but it's $1 million deal, or it ends up being a fix and flip where you're getting $300,000 projects every year, then that more than makes up for the lowered closing rate. I would
Yeah.
say the most difficult and frustrating part of the process is filtering out the serious from the non-serious borrowers.
I've definitely gone through that myself in this space, or if you can even help them to begin with, because maybe it doesn't even have any legs, whatever project. And initially it sounds good, but then when you start digging into it, it's like that actually would have been like a small business loan or something like, as opposed to a real estate transaction. Speaking from experience here, but definitely can be challenging, but rewarding. Thus far, what would you say has been your favorite moment in doing commercial real estate? I know you've mentioned some things that were pretty nice in one of the previous questions, but what would you say is your favorite moment?
Closing my first deal. I don't think it gets any better than that. It was one of the smallest I've ever closed, but it's kind of validation of a lot of hard work because that first one is always by far the most difficult one. Again, one of the things that makes this side of the industry easier, if you're willing to go out and market, is I'm licensed to do residential real estate in Florida. My first loan that closed on the commercial side was not in the state of Florida. It was in another state entirely. We do business in 42 states and counting. If someone's willing to go out and market over the internet, through mailers, telephone, etc., there's 42 states to potentially source business from, not just the one you're living in or not just the ones you're licensed in.
Big advantage because I know as far as the broker side of things and on the residential real estate side of things, we have to get a license in each state. And that can get very expensive. I know of a couple of loan officers that have it set up where they have a team of loan officers and they're spread throughout the states in order so they can cover all 50 states. Very expensive, but commercial, it's not like that. As long as you've got someone that can do the deal and there's a plan, then it's like, oh, okay, great. We can do this. So I think that's a part of what you were saying earlier about who's serious and who's not when sourcing the deals. The first close, the proof of concept, love it. Now that we've know more about you, Hani, let's talk more specifically about commercial real estate. So for those who are brand new to the space, how would you define commercial real estate, Hani?
Commercial real estate is property that's going to be used solely for business purposes. So it could be an office building, warehouse, multifamily apartment building. So it can be a residential space just as long as it's not someone's primary. I like to describe it as anything that's not a person's primary. There are
Mm.
exceptions, like we generally won't do gas stations. I know you have a little bit of experience with that.
Yeah.
Let's call it any real estate that generates income, right? Whether it's through leasing, renting, or operating a business on the property.
If you guys are getting value from this video, make sure you hit the like button on the video so we can get this out to more people. Who would you say commercial real estate is for?
For absolutely anybody. It is for investors, if you want to put a term on it.
I figure
Anyone
it
that
out.
can pass a background check.
There
So
you
there
go.
are
Yeah.
certain people that we're going to be filtering out from the very beginning. No bankruptcies, financial crimes, certain other kinds of crimes, but anyone can do it. As long as they have an LLC, the borrowing entity has to be a company. It cannot be an individual. The person has to have an LLC. If they've got the capital, if they can show liquidity, they've got the funds to close, they meet our guidelines, the person does not have to have any kind of experience coming into the commercial space. For anything other than a fix and flip loan, they're going to have to bring a general contractor on the loan with them. I recommend someone who's new to the industry bring in a general contractor on a fix and flip loan as well, but that's not completely necessary. Anyone that's looking to operate a business or lease out space, invest in property for the purpose of income generation is a candidate for a commercial loan. Most of the population can come to us for a loan, even if they haven't ever gotten a commercial loan before.
And you've got a plan. How are commercial real estate mortgages different from residential mortgages, would you say?
There's a lot of little nuances, but there's four major things that I like to point out. The loan size. Our smallest loans on the commercial side are going to be about the size of an average house. Your cheapest, most inexpensive fix and flips are gonna run you about as much as a median priced house. Some people go way cheaper. We tend to not entertain projects for under $100,000, which is already very low. There are certain places I still get inquiries for $70,000, $60,000 fix and flips. Generally speaking, I see my lowest loan amounts come in at three, four, $500,000, and that's as low as it gets. Obviously, when you're getting into new constructions, neighborhoods, then you're talking millions of dollars, right? Where half a point to a point winds up being a six-figure commission. Similarly, because of the amount of risk involved, interest rates are higher. We don't go off of a rate sheet. Our rates do fluctuate according to where the Fed is at, but it's always going to be higher than what a residential loan is going to cost you. That's not just something we do, that's industry standard across the board on the commercial side. That's sometimes a tough sell when you have a brand new borrower, but if you're dealing with anyone that's not completely new to the commercial space, that's something they're already privy to. Repayment terms are usually shorter. Most of these loans are interest-only balloon loans. So unlike a residential loan, which is 15 to 30 years, on the commercial side, you're talking 1 year terms, 18-month terms. Sometimes people finish projects in as low as 6 months. Some of our loan types, like DSCRs, for example, those can stretch out to 20, 30 years. But most of the loan types we do are 2 years or under. One way that ends up being beneficial to the brokering party a lot of the time is, let's say you're out in a state like Texas, like you are. I'm not licensed in Texas. If you send me a loan for someone that's doing a fix and flip, we get them the money, they complete the project, they go ahead and sell, that's the end of the transaction. But let's say they decide that they want to keep it and they want to put a tenant in there and they want to do a long-term loan on that. That now becomes a second loan that you get to do because you get to help them exit out of that short-term loan into long-term financing. So not only have you made a profit off of the commercial loan, the initial fix and flip loan, you're now making money on the NMLS side by helping them restructure that into a 15, 20, 30-year loan. Qualification criteria is much different. On the residential side, we're just looking at FICO. We're looking at reserves and DTI. You're essentially looking to see whether or not the person can afford the property. And if they can buy it. On the commercial side, you as a broker and we as a lender have the right to shut down any project at any point. If we don't like it, if we don't like the numbers, we can just say, no, hey, I'm not comfortable funding that. I'm not comfortable taking that to my lender because that is not a project that meets our criteria, whatever our criteria might be. Your criteria can be, hey, even if this loan can go through, I'm not pushing through any loans that don't have X margin of profit for me. Let's say you have a minimum. Let's say you want to make $5,000 per project that you send my way. Person sends you a project where you're only making $3,000. You have every right to say, nope, I'm not going to work on this because it's not worth my time. I'm shutting this down now. On top of that, we do have minimum credit score requirements, but what we look at much more so than credit is a person's experience, the projects that they've done in the past, and whether they've done anything similar to the project they're trying to do now in order to determine their leverage, as well as liquidity requirements are typically higher than you'd see on the residential side. And most importantly, we're looking at the property's ability to generate income. Just because a person has a project in mind where they're okay with it making a certain amount of money doesn't mean we're necessarily going to be comfortable with that project at the numbers described. Borrowers always come to us with a budget and what they have in mind, and sometimes it's perfect. Sometimes they have the numbers right, but more often than not, borrowers are very optimistic and the numbers don't always work out the way the borrower thinks it will.
I've seen that on a few occasions where they're really pumped up about something. But again, just like in the residential real estate and with the lenders on that side of things, you guys are measuring risk and what's going to be that return on investment and how long is our money going to be held for? How long before we get that return on investment? I think for a lot of the investors, that's a big deal. deal because it's like, well, yeah, it's like someone deciding, do I want to put it in a stock? Do I want to put it in a CD? They're investing, right? So it's like, how quickly can I get that money back? The smaller that time, probably the more valuable that project's ultimately going to be, especially if it has legs and it's got credibility and so forth, like you've been talking about.
On the residential side, the better your credit, generally, the more favorable your rates come in. On this side, someone with a 650 credit score could
Yeah.
potentially end up with a better interest rate and better leverage than someone with an 800 credit score. Because we factor in experience and the project itself much more heavily. So you could come to us with perfect credit, but let's say the project you're proposing is too risky, we're going to tax the interest rate on it. Or let's say you're coming to us with a project where you don't have proof of concept. You've never done that sort of a project before. So you can't show experience. If your GC can't show experience having done that sort of a project in the past, then that interest rate is going to come in higher than it would for someone that has the experience, even if their credit is lower, or a number of other things. On the commercial side, your interest rate, it's not tied to a rate sheet. It's not tied to your credit score. Now, you will take a hit for having really bad credit, but having really good credit isn't the huge advantage that it is on the residential side.
Right. It's more of a profile, an overall profile, as opposed to
Exactly.
one particular exclusive thing like we see a lot of times on the residential.
Not all profits are created the same. Let's say we have a project with $100,000 margin of profit. If that's on a $400,000 loan, if that's on a $300,000 loan, great, you're making 100K on that. We'd be more than happy to fund that. If you come to us with a $100,000 profit on a $1.2 million project, then that's a garbage deal. We don't want to look at that. So it's not just about the raw dollar amount as far as, returns on the loan. It's what percentage of the loan amount are you making back in profit?
No, it's very important for people to know the difference between the two because it can get confusing because there's a lot of similarities, a lot of parallels. Another thing that is different, of course, are the restrictions and regulations, as we've talked about previously, when it comes to licensing. Also, things like kickbacks, RESPA, TILA, all that stuff essentially goes out the window because commercial real estate isn't held to the same degree of scrutiny.
Those are all terms that I leave out of the conversation.
Yeah.
You people get scared when they hear the word kickback. I'd like to call it a referral fee or a commission because that's really what it is. Regardless of the label that you have on the NMLS side, you're working as a go-between for the loan. Construction workers, maintenance guys, nurses that have zero licensure, there's no conflicts of interest.
No, that's definitely a plus, I would say. I mean, I get why the CFPB does what it does. Of course, 2008 is the reason for all the strict rules in residential, especially for folks that are not maybe educated enough in the financial realm to safely make something without being taken advantage of. Obviously, this is looking out for everyone
Absolutely.
else
That's
that's
why the
going.
number one thing that'll kick a person out of our loan programs is if the property is going to be used as their primary, if it's their primary residential, we cannot do that loan. If their primary residential is being collateralized in order to acquire that loan, we cannot do that loan. Any commercial loans have to be independent of the person's primary. In no way can any of these loans risk a person losing the house that they live in. Why the borrower has to be an LLC, right? When it's the
Right.
LLC, if they were to default on that loan, sure, the lender could come after them for the property that was being worked on. They
Mhm.
could come after the company's assets, but the borrower's personal assets would not be affected. In essence, the borrower is a different entity from the person. So the
Yeah.
person is who owns the house. The LLC does not own the house. So if the project goes belly up, going after that person's primary is not an option to begin with.
We want to make sure it's a separate entity, as the tax code will tell you. It needs to be, in this case, an LLC, but there are other things out there, S corps, C corps, things like that. But it has to be a company, and I count that as people in a sense.
So I misspoke a little bit. Most of our clientele has LLCs, but it can be other kind. It just has to be a
Oh,
business. entity that's borrowing.
Okay, gotcha, gotcha. Okay, as long as there's that separation of entity. I
Exactly.
gotcha. How would you say a commercial real estate loan works?
A commercial real estate loan would be used to finance the purchase, let's say development or refinancing of a property for the sole purpose of business. So that's leasing, renting, generating income. Once someone pitches me a deal, I and my underwriting team would assess that property or that project's potential to generate income, see where it's at, whether that's a DSCR loan where there's monthly rent being generated. Of course, we're evaluating the borrower's ability to repay the loan. That would essentially be it. The loans would require a larger down payment, interest rate would be higher, all the things we've discussed so far. And one key point is the property itself, the property that's working on, can be used as the collateral for the project. So let's say if someone owns a piece of land free and clear and they want to build something on it. As part of that loan, we can pull equity from the land and look at that as a cost already paid towards the project. A lot of the time when we're in that situation, not only are we able to finance interest payments on the loan, oftentimes the loan ends up being free, quote unquote free. You always pay for it at the end of the day because there is a balloon payment involved. When a person owns a piece of land free and clear, oftentimes they're not having to bring any cash to close because they've already gained enough equity in the land to be able to cover closing costs and have my lender feel comfortable with funding that project. If someone's got a
Yeah.
$300,000 piece of land that they own
Mhm.
free and clear, and they're coming to me for a $300,000 loan to build on it, that gives my lender a lot of confidence because that says to them, hey, this person's willing to collateralize a $300,000 asset for a $300,000 loan. Obviously, they're very comfortable with doing this project because if it doesn't go through, I, as a lender, gain a $300,000 piece of land and can then go through and finish out the project and collect all the profits myself.
I think that reminds us all why it's so important to deeply consider HELOCs and things that you borrow against your asset when doing it. You got to make sure if you're going to do that, that it makes sense with the numbers, it makes sense with how you're going to do that, like who's going to do the work. All that stuff needs to be planned out before you just go and do it. Because then that means the lender's going to essentially own that asset for a discount if it doesn't end up going very far.
Our lender is not a punishing lender. We've been with them for 3+ years.
Mm.
We've yet to repossess a property as long as I've been with the company. That's not to say that we won't, but they're very friendly to the borrower. They all come with extension options. If at the end of the loan term you haven't finished the project, if the weather wasn't right, you had a snowstorm which closed down construction for 2 months, hurricanes that came through, etc., etc., there's always the option to extend the term of the loan. Similarly, if someone comes in for a 12-month term and they end up finishing out the project in 8 months, a lot of our loans, for example, our fix and flips, come with no prepayment penalty. They're not going to be penalized for not keeping the loan for that entire 12 months. The last thing we want to do is repossess someone's property because that's a one-time deal and then that person is never going to come back to us. I would much rather make it an easy experience. I'll turn down a deal where it looks like the project will end up falling through. I don't want to repossess a person's property because I want a person to have a good experience with me and then come back to me 3 times a year, 4 times a year. I would much rather have the repeat business. That's why I play the game.
So we'll go ahead and start breaking down some important terms that get thrown around in the commercial side of things so that way people have a clear understanding. What is ARV?
It's an acronym for after repair value. It's most important in the fix and flip space. It's what we estimate the value of a property to be after it has been renovated or repaired.
You'll hear that term get thrown around. It may even be asked as you're applying for a commercial loan. What is the ARV?
When
Here
someone
it is.
submits a loan application to us for a fix and flip loan, or as we call it, a renovation bridge loan, is a fix and flip loan as a type of bridge loan. We'll have them give us an estimated ARV. Then we'll look at the budget and estimate our own ARV. But ultimately, It is the appraiser that determines the ARV. Commercial appraisals are their own thing, separate from residential appraisals. A commercial appraisal is done with a budget in mind. So when an appraiser goes out to that property, they've got the budget in hand and they know what's going to be done to the house. And along with the appraiser's findings, one of the things that's included in there is the appraiser's estimated ARV. And ultimately, that's what we go off of. The broker can come to us with a number. We can come back with our own number, which is going to be more accurate. But at the end of the day, it's the appraiser who determines the ARV.
As far as the basis, it's like, well, we got a lot of numbers flying around here. It all kind of sort of mean the same thing. What's the basis? Similar to the residential, whatever the appraiser says, that's what's going down.
Appraiser's word is final.
Then another term that gets thrown around a lot is draw. What is a draw? Are we doing quick draw? Is this the Western? What's going on here?
Our draws are very quick compared to other lenders, typically within 24 hours. A draw is essentially just a disbursement of funds from us, the lender, to the borrower and or the contractor. It's typically they're dispersed after the completion of a phase or part of the phase of a project, unless someone has a ton of experience and they qualify for our advanced draws, which means we give them money before the work has been completed. The way draws typically work, let's say someone's doing a fix and flip and they're renovating the kitchen, 2 bathrooms, 3 bedrooms, and a living room, right? So that's 6 or 7 different areas that we'll have budgets for and we'll have an allotment of funds for. Let's say they're putting $10,000 into the kitchen. The borrower, the person doing the fix and flip, they put that money into the kitchen. So they spend that $10,000 in completing the renovation on the kitchen. They send us pictures, or we have someone go out there to inspect the property to make sure that the work has been completed. They show us proof of funds that were spent. And once that portion of the house is completed, we reimburse them the money that they put into that. It's a very common misconception that a draw for a fix and flip is going to be paid out and then the work is going to be done. It goes the other way unless you have a lot of experience and we trust you. So for most people, especially for let's say their first 5 or 6 fix and flips, they're going to have to fund the individual phases. And once each phase is completed, we reimburse that money.
That's an important distinction because I would think that that's how it worked too. I remember when we were first having discussions, that's literally how I thought it worked. But I think the advantage there, kind of a hack here that we've talked about in the past, is if you have a high enough credit limit on a credit card, for example, and you time it out just right, where you don't have to pay any interest on that credit, then you could effectively get a rebate with the cashback, whatever that ends up being on the card, and then get reimbursed by Hani or any commercial lender at that point and pay off that credit before the interest is charged. So there's a little bit of a hack there. You got to work on the timing. I feel like that's the most important part of that.
There's plenty other tips and tricks of the trade. We're very flexible. So if a borrower comes to us and they're looking to put in as little of their money as possible, we've got part suppliers that operate on heavy discounts. We've got people that might be able to provide services for cheaper. Once you're past that first or second draw, it gets much easier. You're flowing. You pay 10,000, you get paid 10,000. You pay 5K, you get paid 5K. Breaking ground is the most difficult part. Let's put it that way.
Let's go ahead and get definitive here. What is a phase?
Phases refer to stages of a project. So
Hmm.
let's say demolition, construction, finishing, right? Let's say you've got a house where you need to tear down a bunch of walls. That would be the demolition phase, and that would have its own set of draws associated with it. So you take a hammer to a bunch of walls, break them down, let us know how much that cost you, and we reimburse you for that phase. Next phase would be construction. So you're putting walls back up, you're refinishing stuff, you're putting in tile. You do all that, you send us pictures, you let us know how much it costs you, and we reimburse you for that. Then you might have the finishing phase, which would be painting, putting in appliances, doing electrical work, fixing up the roof, etc., etc. You send us pictures of that, let us know what you did, we send you the draw on that, and you're reimbursed for your money. Phases are just a way of breaking down a project we know how the money is going to be allotted and when what work is going to be done. The phases I just described were for a small scale fix and flip. You can also have a neighborhood with 90 houses going up that's phased out. So you might have phase one would be horizontal, where the contractors are simply going through and doing all the horizontal building, meaning parking lots, lighting structures, telephone poles, traffic lights, things like that. Phase two might be 10 houses. Once they have proof of concept on the 10 houses, phase three might be 40 houses. Phase four might be another 40 houses. Phases are simply a breakdown of how the project is going to go, and you could look at it as a timeline for the project.
So it is similar to the Marvel Cinematic Universe where we have phases and all these
That is,
movies and shows will come out
it is
during this phase.
exactly like the
Yeah,
Marvel
okay.
Cinematic
There you
Universe.
go. Yeah, I knew there was going to be that connection. Always those connects. All right, perfect. Now we're going to talk about the different loan products that exist in the commercial real estate space. Let's start with the first one here. What is a fix and flip loan?
It's a short-term loan that's used by real estate investors. Again, it can't be your primary, in order to purchase a property to renovate and sell for a profit. By far, the most common type are fix and flip loans, or as we like to call them, we're trying to get into the practice of calling them renovation bridge loans. Reason being, there's multiple exit strategies. Most people decide to flip after fixing, but a lot of people decide to fix and rent, for example. So they'll take out money for a renovation bridge loan, they'll renovate the property, and instead of liquidating at the end, they'll decide to refinance into a long-term rental loan, and they're holding that property in their portfolio and they're just collecting monthly income from it instead of collecting a lump sum. The loan typically covers the cost of purchasing the property as well as 100% of the repairs on the property. It's an interest only loan, and typically, in most cases, the loan is repaid once the property is sold at a higher price. So someone takes out a $100,000 loan on a $200,000 property that ends up being a $300,000 loan. They sell it for $500,000. They pay us back $300K plus fees. Let's say the fees come out to 30,000. They pay us out 330. All the third parties get paid what they paid, realtors, etc., etc. And whatever's left over ends up being the profit for the borrower.
We're looking at least six figures on that profit based on those calculations, I would estimate. So that's pretty good.
None of the numbers I'm describing here are real projects. They're just numbers I'm using to illustrate a point. For people that are looking to get into the commercial space, advertising the fix and flip loans, your easiest way in, right? They're the most common loan types on the commercial side, in my personal experience. I'm not going off of any kind of numbers I've seen. I'm just going based off of the deals my brokers send me.
We've already talked about this too, and kind of what the official name is of the fix and flip, which is the renovation bridge. But let's get a little bit more basic. What is a bridge loan?
A bridge loan doesn't have to be a fix and flip loan. A bridge loan is a short term loan that's used to bridge the gap between the need for immediate funding and the ability to secure long-term funding. It's very commonly used by property buyers to purchase a new property, let's say before they sell their current home. So they
Yes.
haven't sold their current home yet, so they need X amount of money for something that they're going to do, but they haven't liquidated their home yet, but they plan to in 6 months. So they'll take out a bridge for that term, knowing that at the end of the day, they have something to sell in order to pay that back. It's a way to secure quick financing until you get your long-term financing in place.
Very transitional for a lot of folks between
Yep.
one point and another. And I've seen it being used in creative financing, especially in the residential, where they don't want to have mortgage insurance. So they'll utilize the profit of a bridge loan in order to put down the payment that equals 20% on a conventional. So that way they don't need to worry about mortgage insurance, even though they only had 10% or 15% to put down on that loan. So the other part of it, they took out a second loan they were going to pay back with the selling of the house later. Just to give us
Right.
some ideas of the parallels, because bridge loan is a bridge loan,
It's the same
residential.
thing on the commercial side as it is on the residential side.
What is a DSCR loan?
DSCR stands for debt service coverage ratio. Simply put, it's a type of rental loan that evaluates the borrower's ability to repay the loan, not based off their income from their 9 to 5 or their day job, but based off the income generated by the property. Usually it's represented as a decimal number. That's why we call it a ratio. A property with a DSCR ratio, a debt service coverage ratio of 1, means if the mortgage is $1,000 a month, mortgage, including taxes, HOAs, all that, if the expenses on the property are $1,000 a month, that means that person is charging their tenant $1,000 a month. So that comes out to a ratio of 1, meaning the rental income is covering all the expenses and nothing else. If they were charging $1,200 on that property, that's a debt service coverage ratio of 1.2, meaning all of the expenses on the mortgage are being covered by the tenant, plus the borrower is leaving with a 20% profit compared to his mortgage every month. We entertain DSCR loans 1, sometimes lower than 1, but 1.2 is the benchmark. A 1.2 DSCR is considered a great rental property. And if someone comes to me with a 1.2, in most cases that's going to close. Most cases a 1 is going to close. Sometimes a 0.8 will close. But the lower that ratio, the less favorable terms get and the less attractive that deal looks to my investors.
I think that's something to keep in mind as you get into more non-QM and more commercial direction is those interest rates and those favorable terms. They become not as nice the more risky project ends up being because they have to make sure that even if that goes sideways, they still get something out of it. So that's the reason it's like that. So if you go into it, great background check, your credit's amazing. There's a lot going for you. Boom, it's going to go well. If not, then get ready, especially if you're starting and this is just kind of where you're at, just be ready for less favorable terms. Well, then the final loan product that we need to discuss today, though it may be a bit self-explanatory, what is a new construction loan?
New construction loan, it's a short-term loan, again, typically 2 years or less. It's used to finance the construction of a new property. In this case, from the ground up. You could have a teardown phase in a new construction. It wouldn't necessarily count as a fix and flip. But generally speaking, you're starting with a piece of land that has nothing on it, and the developer or investor is going to use those funds to build a property on that piece of land from the ground up. And once construction on that project is completed, the loan is either going to be repaid through liquidation or it's going to be converted into a permanent long-term mortgage, which
Okay.
would also end up in that short-term loan being repaid.
Yeah, yeah. I think if I'm not mistaken, most of like the neighborhood projects you probably get fall in the new construction if it's just land direction. Because we talked about that previously, where it's like a whole
Yes.
phase of 40 houses. That's new construction. That's the product that probably
Those are
falls
new
under.
constructions. If you're driving around and you see a plot of land in the neighborhood that just has a sign on it with a developer's name on it, that's someone who's coming in with a new construction loan. When you see these deals where you have a neighborhood that's going up and you have a GC that's selling directly to people that are in the market for a residential, that GC got the funds for that project most likely through a ground up construction loan. He or she is paying that loan back by either taking pre-sales or liquidating individual houses or blocks of houses from that neighborhood and then using those funds to pay back the loan amount.
Getting close to our conclusion here, I got a few more questions. What are the most common questions you get while working on a commercial real estate transaction?
A lot of the stuff we've discussed here, honestly, it's always about money. How much can I charge? We can always have those conversations. From borrowers, it's always about timeline. How long to get my money? How are the draws going to work? What's my portion going to be? How much do I have to come to the table with? Those are the most common questions. It always comes down to the money. That's the whole reason anyone is in commercial real estate. Again, these are not properties that anyone's going to be living in.
Mhm.
So you're borrowing money in order to make money. Questions are naturally always money related.
If someone was interested in getting into commercial real estate, what should they do? Maybe even what is the first thing they should do?
The first step is to have experience. If you don't have experience, how do I get experience? It's like one of those things when you're applying for a job. They want you to have 5 years of experience in a field while coming straight out of college and want you to have worked 25 hours a day for the last 5 months, all kinds of ridiculous stuff. Getting experience in this context means finding a GC to come on the loan with you, right? That has done projects like that before. If a GC were to come on the loan with you, then that GC's experience is your experience. So even if you have zero experience in the real estate space, zero experience doing fix and flips, you find a general contractor that has done 10 fix and flips in the last year. We look at that as you having done 10 fix and flips in the last year. The first step is to either educate yourself, already be in the construction space. If you're looking to do the project yourself, finding a GC to work with is very important because once you have the GC with the experience, you get maximum leverage. At that point, it's simply a matter of finding a property. So you want someone in the real estate space that you're working with to find viable properties that are not selling at a premium that you can actually fix up and then make a profit on. If you have access to listings, go out and find distressed properties. Go out and find properties that were recently damaged that you either personally feel comfortable with fixing up yourself or you have a GC that can fix that property for you. Like I have a borrower. She does not do any of the work herself. Came into the industry with zero experience, but she's got a nephew who comes on the loans with her who owns a mold remediation and water damage repair business. And this is South Florida we're talking about. What her nephew goes in and does is anytime there's been flooding or rain damage or anything, he goes in, puts tarps over the roof, empties out the property, fixes everything that's wrong with the property, and then moves everything back in for the person that hired them. So a person can go on vacation, come home to a property that's been hit by a hurricane. They use these people for their services, and all they have to do is leave their house for 2 weeks and they come back to a brand new house. So that person that does that for a living already has the skill set required to perform a fix and flip, even though they're not technically a real estate professional. So
It's
this
like
person has their GC license. He works with his aunt. His aunt sources the deals. He goes in and does the repair work, but rather than having a family move back into that property, they then put the house on the market and they sell it.
a lot of mix and match when it comes to the commercial side of things. So don't count yourself out if you don't have experience. I think that's what the moral of this story today is. If you know of somebody, maybe a friend, family that's in the space and they can vouch for you, especially if it's a GC or general contractor, or perhaps someone who's in the mortgage industry or real estate industry, they can look for the deals and find it. You can collaborate with that person. Maybe you've got the capital, just not the experience, not the skills. So there's a lot of mix and match, I feel, on this side of things, which is kind of cool. A lot of people hear the word hard money lending, and they get confused. At least I know I did when I first heard that. I'm thinking there is a certain texture to money, soft versus hard. What are we talking about here? So
Yeah, we're not
in
talking
your
about
own words,
coins.
yeah, there you go. Yeah, we're gonna talk about crypto. That's it. That's the soft money, right? Because it's just data. In your own words, how would you define hard money lending?
So we've got investor money. Let's say I get a project. We have a network of investors, each do different things. We go and pitch that project to them. Someone bites. and they come back with, yes, we'd like to fund this project. They set their terms for where they see the interest rate at, where they see the ARV, et cetera, et cetera. And we get that term sheet to the borrower. That is investor money. That's technically not hard money.
Mm.
Hard money is as good as a cash loan. It
Oh, wow.
comes from our personal reserves. So it's money that comes from our brokerage. It's always short term. It's going to be higher interest rate. It's collateral based. It's used for all the same loan types we've described so far. Let's say a hard money loan would come in when investors don't necessarily feel comfortable funding the project. It's a double-edged sword because if the investors don't feel comfortable funding it, we might not feel comfortable funding it either. As of right now, most of our hard money is limited to the state of Florida. That's not to say that we wouldn't fund somewhere else if it was a really good deal, but when it comes to hard money projects, we like to be able to check out the property.
Yeah.
And the reason for that is because it's much more flexible. There's very little requirements for actually getting the loan. Sometimes we can do it without a credit check. Sometimes we can close within a week. I've seen deals close within 3 days before. I've had someone come to us for a purchase on a Tuesday and they were in the property by a Thursday, Friday. So there's a ton of flexibility because it's literally as good as us cutting someone a check,
Yeah.
but it's a more complicated and less complicated process at the same time. The eligibility requirements are less complicated, but the strings that it comes attached with are a little more difficult for most people to work with. Interest rate is going to be a few points higher. I've seen people regularly come in at 15% on these loans before. And people see 13, 14, 15%, and that really turns them off. But you got to understand that loan is coming in at a 15% because no bank and no other entity is going to fund that project. So
Yeah.
if you want to do that project, those are the terms that you're going to have to take it at.
It's like we talked about previously, the riskier it is, the less favorable the terms are going to be. And I feel like the hard money, because it's coming from your own cash reserves, that's why there's a low barrier to entry and a lot of strings attached and a higher interest rate. But I also feel like it's kind of like the fill in. Okay, the investors won't take it, but maybe it's not completely off the table. Hard money.
There's also certain deal types, there's also certain kinds of businesses that banks simply won't fund. For example, one of the inquiries we get out from the West Coast, places like Oregon all the time, is marijuana dispensaries.
Oh, wow.
And while it's legal in those states, it's federally illegal. So banks that are federally regulated will not touch a loan like that, but we will. Same with, like, we got an inquiry for a whiskey distillery not too long ago. Unfortunately, we weren't able to fund that project, but we funded a marina out in Tampa Bay recently. That's something that that person was not able to get traditional financing for because a lot of the lenders were like, hey, what happens if a hurricane comes through and destroys Tampa Bay? And now there are no more boats and no one wants to live there anymore and use the marina anymore. There's certain kinds of projects where the profitability is there, but investors or financial institutions might see it as being too risky for their taste, whereas we don't see that as a risky project at all.
A different perspective. If the money's right, the math is right, the risk profile is right, then of course the bank can't do it because they've got regulations, they've got things they can and can't do based on higher powers that be. Whereas you guys, you're not, which is really great as an
Well, and
alternative
their
option.
and their logic is kind of sound. Like, hey, if the collateral is a piece of land that's 2 feet above the water, what happens if the water rises 3 feet? Now
Yeah,
there's nothing to repossess, that kind of thing.
yeah. Hard money is more utility, I guess, in a sense of if it keeps getting no's, then maybe hard money is the last resort, the last thing that we could maybe rely on because of all the strings that are attached.
Or maybe someone has something in their financial history where a hard money loan is the only route they can go.
If you guys are getting value from this video, make sure you hit the like button on the video so we can get this out to more people. Do you have any final words of wisdom that you'd like to share with the audience today?
Same thing I would say on the residential side. You got to do your research. know the different loan types, understand the numbers. You want to know what the loan types are. You want to know about concepts like cash flow and ROI, return on investment. When you're working with investors, you want to make sure that you always know more than the investor. These are individuals that are used to funding these kinds of transactions or going out for these kinds of loans. Oftentimes, they're people that are fed up with banks, so they don't want to work with banks anymore, so they want to come to you and work with private lenders. So you need to be able to tell them what you can do for them that would be superior to a bank. You got to be on top of things. You got to understand the numbers. You got to always be prepared for setbacks. It's very common to finish 9 out of 10 steps on a loan, and the last step is closing, and it just never gets to that last step. It's very challenging in that regard. So you got to be prepared for setbacks, and you can't get demoralized. Don't count your chickens before they hatch. You get a $30 million deal that's going to put $200,000 in your pocket potentially. Don't start operating like you're someone that's made that 200K already. That money has to hit your bank account before you count it. More often than not, those deals don't close and there are setbacks. But, you do 10 of those, one will close after having setbacks with 9. Don't get too emotional. Don't always go for the home run. Go for base hits. And I see this across the board, especially with young, hungry people. Every deal they'll send me will be a 10, 15, 20, $30 million deal. And then none of them
Jesus.
close. And then they send me a $300,000 deal and it closes in a week. And they send me another one for 400,000 and that closes in a week. And they're like, "Hey, I wasted all this time sending you these huge deals that I thought that was going to make me rich on one hit. But turns out that I can employ this formula and I've got this domino effect where every new borrower I bring in is doing 2 or 3 of these a year. And now I'm doing 12 to 30 deals a year at a loan amount of 3 to 500K that I'm making 2, 3, $4,000 on per loan." So I would say start small and scale gradually. Don't go out looking for the home run. Let it come to you. Just network with the right people and it'll come eventually. When it does come, be on top of the financing options. Know what it is that you can offer those people. And when you've done it on a smaller scale, when you've done it on 3, 4, $500,000 loans a bunch of times, it's not difficult or intimidating talking to somebody about a 15, $20 million loan because it's the same thing just with bigger numbers.
It's very powerful. We gotta keep working it. Now, on that note, also, if you guys would like, subscribe to the channel. We're going to be talking more about financial education in the coming videos, so that way you can be an investor, and that way you can be an informed investor, and also someone who can potentially present deals, maybe these commercial deals that we've been talking about today. So definitely check it out for more videos coming. But Hani, I wanted to thank you for your time today and answering all these questions. I appreciate you, man.
Hey, you're very welcome, David. It was an absolute pleasure.
Yeah, man. So again, guys, thanks for coming by the channel and thanks for joining us today. Guys, hope you take care. And until next time, stay blessed.